we end up doing is we improve the business, we repay debt, or we just grow the value of the business. And then at some point we exit. Next slide, please. Put in perspective on a house. If you buy a house that's worth $100 on the left, you put $25 in, you borrow $75, and at the end of 5 years, if you've paid your mortgage down, your $25 million can be worth $75, or your $25 can be worth $75. And in that case, you've gotten a 25% IRR. That's kind of the objective of what we do. Go to the next slide. But that's just keeping the house exactly the same as you bought it. Now, what we try to do is improve that house. We buy a house, we borrow 75, we put 25 of our own money in, and then we hope to improve things, grow into new markets, as I said, improve the company in some way. And if we can improve the value of that house to $200, and we pay down a little bit of debt, then we end up having our equity go from 25 to 150, so we can make 6 times our money, which is obviously better than the last one. So this is when it all works out well, and that kind of return, that's basically what we're trying to do. Next slide. So leveraged buyouts are pretty common. They've been, they go in waves, and it's a cyclic business, and there was a tremendous amount of activity. If you think about it, if I showed you those funds and the way we raised those funds, this business is always changing. Everybody keeps saying, wow, it must be a really active time in your business. I said, well, look, I've been there since 1998. Every week of every month of every year has been a really active time in my business. I will say, though, that it's changed dramatically over the past 10 years, let's say. The scale and the size of the funds that we were able to raise, and therefore the companies that we're able to buy, has grown dramatically. So just a couple of examples of the types of companies. Neiman Marcus, you might know, Harrah's, the casino and hotel business. Aramark, which I think is a service provider here that provides the food services, that was a company I was involved in. We took the company private about 3.5 years ago. That was an $8.5 billion buyout back then, and we still own it today. It's a very good business, and we teamed up with the management team there to take that company private. First Rent-A-Car, RJ Arvisto is one from way back that people might be familiar with. Go ahead. But there are a number of very, very well-known names that have gone through some kind of leveraged buyout. And leveraged buyouts can be healthy. They also can be damaging depending on if they're done right or not. But essentially what you do is you acquire companies with debt. What we try to do is we try to empower the people who are driving the companies to act like owners. So we do give heavy equity incentives to the management team because we want to align the management team with us. So we turn people who work there into owners, and Mira is very familiar with this. She's been a partner of ours in businesses, more than one, and currently now, where we, on the Goldman Sachs side, we know we're capital people, we're deal people. We bring capital to the table. I don't run companies for a living. People like Mira do. And so we partner with the best-in-class operators and companies, turn them into owners in the partnership with us, and we go out and try to improve these businesses. And then you monitor it, and then you find the right way to exit. Like I said, it's typically 5 years, plus or minus. Next slide, please. So the market overview. This is the last little set of slides I have. Go to the next one. The private equity business, what I'm showing here is the S&P 500 is the line that's bouncing up and down. And this is a chart from 1998 until today. And the leveraged buyouts, the number of leveraged buyouts or the value of the companies that are bought are the bar charts. So you see over here, and this was the heyday slash, I'll call it heyday, you'll call it insanity, of leveraged buyouts going up through the 2006, 2007, 2008. And those bars represent a lot of money. The top bar there is $150 billion of companies. In that particular quarter, $150 billion of companies were bought through leveraged buyouts. And as I mentioned, our funds, the size of our funds were quite large. To put it in perspective, just from my personal experience, the first major deal I drove was in 2001. In 2001, I bought a company called IPC, which makes phone systems that sit in front of traders on trading floors worldwide. That was a big deal. It was right after 9/11. The whole world was shifting. We invested $165 million, and we bought the company for $360 million. It was October of 2001. For a week, I couldn't even get into my office on Broad Street. I had to use lawyers' offices in Midtown because downtown Manhattan was occupied by the military, and we just couldn't get through. We ended up driving that transaction, and that was a massive deal back then. And so, to put it in perspective, it was a $360 million company, $160 million investment. Fast forward a little while later, as I mentioned, Aramark came in right at the beginning of the really build-up. Aramark was a massive deal. So forget the $360 million deal, an $8.5 billion company that was a public company that we were going to take private. And in that business, we invested $2 billion and borrowed $6.5 billion, teamed up with Joe Neubauer and that management team to buy that company. That, at the time we got started, would have been one of the top 5 buyouts ever done. And the whole world started really lifting in terms of the size of companies we were able to buy. And we sat back and thought, well, that is a dramatically big business. Until about 3 months later, the guy in the office next to me was taking Kinder Morgan private, and my $8.5 billion deal was the amount of equity he was putting in, buying a $25 billion company. And I wanted to describe that because it puts in perspective the size of these deals over a really short period of time. And what happened was the credit markets were wide open, so we were able to borrow money at relatively inexpensive rates. These were terrific companies. And we were able to also gather assets. The fact that we were able to raise $100 billion in these funds over the last 10 years is dramatic. That's a tremendous amount of money. And by the way, the funds, those $100 billion, they're managed by me and about 30 other people like me at Goldman Sachs. That's the size of the team that'll manage that pool of capital. Now we have 200 people in our group worldwide, but it's about 2 dozen or 3 dozen that actually drive those investments. So you're concentrating a lot of capital into a small number of hands, and we're able to then go out and make investments in large companies. I'll submit to you that whether it's venture capital and putting $1 million into a new idea, or it's a buyout of a $10 billion company, the theses are about the same. You want to go in and you want to create value and want to improve those businesses to get a financial return. That's the objective. It's just, it comes in a different form of buyout. So next slide, please. But we also, we also saw that the economy in the world came crashing down, right, in 2008, 2009. Now, the economy cratered. The credit markets closed up. We still have a tremendous amount of capital in our funds. If you put it in perspective, I invest out of a $20 billion fund. We still have about $8 billion of dry powder. So capital is sitting there to make investments today. So we can be very active in an environment that's a very weak environment. We can put money to work, which we have. We've invested a lot of money through the last 2 years. But the leverage buyouts stopped because the credit markets froze up. Credit markets froze up for people like me and people who wanted a mortgage and all different types of folks. Everybody ran into the same credit problem. Credit markets have been coming back. So you see it starting to pick up here, and I'll show you that a little bit. Go to the next slide. Equity markets have, since March 9th, have been on an absolute tear, as we all know. Notwithstanding the fact that last week we had that dramatic dip that gave everybody a little bit of heartburn. What it does is it reminds us all we live in a very fragile economy. Let's not kid ourselves. This is not a good, healthy economy, and we're looking out into good prospects going forward. None of us feel that way. The equity markets have been on a tear, and my business, and the private equity business, and particularly the large cap buyouts, has really dramatically changed in the last 3 months. So the number of good companies that people have decided to sell has gone up dramatically, and we're about as busy as we've ever been in buying these companies. Next one. And this just shows that the credit market has dipped and essentially cratered, has come back, and so the credit market's opened up in the past, probably the past 6 months or 9 months. It really opened up a lot in the past 2 or 3 months. So you see that that part of the economy is coming back a little bit, and that will lead to more transactions, better deals, and we're also getting further away from everybody's businesses falling off by 50% or 60%. But we're still at anemic levels, but they're at least stable, and maybe in some cases showing some signs of the uptick given the stimulus.